Welcome back. Banks were the standout performers of the just concluding results season. Within banks, if one measured on net interest margins, the standout performers were ICICI Bank, Kotak Bank and Bank of Baroda, each improving their margins by 20 to 30 basis points. But if you look at from the return on assets perspective, then SBI and BOB also joined the list. They improved almost as much as ICICI Bank did. Now, of course, Kotak Bank again remains the outstanding performer in the ROA improvement list. I'm only looking at incremental numbers. Today, we discuss valuations. Are they all priced in? And the outlook ahead, what with new developments like the expected credit loss provisions that Reserve Bank may introduce sometime this year, the 2,000 rupee note withdrawal, and perhaps the end of the rate hiking cycle as well. Joining me for all this is MB Mahesh, the banking expert from Kotak Institutional Equities. Good morning, Mahesh. Thank you very much. Pleasure having you with us. Well, let me start with margins then. Because of this 2,000 rupee note thing, the feeling went around after the perfect Q4 margin performance that this is the peak. Do you think Q1 will be a repeat of Q4?
Hey, hi, good morning, Lata. We think margins have peaked for sure. There is enough evidence to suggest that most of the incremental rate hikes which the banking system had to take on the loan side has practically gone through. Especially banks which have got a very large share of retail loans in their balance sheet. I think that pass-through is more or less coming to a close. Banks who have got a larger share of MCLR-led book, there I think there is still some repricing available on the loan side. But if you look at it on the other side, if you look at the cost of deposits, I think there we still have a long way to go. Banks have been consistently increasing deposit rates. And there's a lot of lead lag between the way the loan prices and the deposit prices. So the answer to your question is yes, we would expect margin contraction as we go along over the next 3 quarters, with probably Q1, Q2 being the worst of the numbers coming ahead for all the banks in general.
But since they may not have to increase deposit rates, is there not a chance that April, May, June, they will get away with the same margin as Q4? No such a chance?
Looks tough. The main reason is if you look at the loan book usually reprices between a 3-month period all the way up to, let's say, 6 months to probably, if you have a loan on the MCLR side, of approximately about a year's time. But if you look at the deposit side outside of current account and savings account, you have the term deposit book, which usually has a maturity of 1 year. So when the rate hike cycle started off beginning last year, the full impact of it will start coming in from Q1, Q2, Q3 when that deposit book starts to reprice. Okay. So I think the short answer to your question is that you will see more deposit costs going up for the banking system as a whole. And as a consequence of it, margins will have to come down for all the players, for nearly all the players at least.
Okay. There are some people who are even factoring in a rate cut as early as October. I think I saw a Nomura report, but it's not everyone's base case at all. Then we will discuss a different kind of margins perhaps. But at the moment, you're saying it'll come down. But for the best of banks that we were discussing, the banks that showed very good margin growth, I think it was ICICI, Kotak, Bank of Baroda. In all this, how much do you think margins can go down? 10 basis or even more?
Well, the numbers are a little bit all over the place right now. When you speak to, when you look at the balance sheets of various players. But the way we are building it right now is that margins will kind of compress anywhere between 15 and 20 basis points as we go along during the course of this year. And these are numbers which we are looking at it on a YOY basis. So you will see banks which have got a higher share of retail loans having a much higher pressure on margins, whereas banks which have a higher share of MCLR loans having a lower pressure out there. If what you say is true, and if you do see rate cuts coming through during the course of this year, then the outlook changes even more to the worse, because then the loan book starts repricing downwards, whereas the cost of deposits may still not have completed its entire cycle on the way up. So it's a question of this lead lag has created a lot more volatility in net interest margins as compared to where we have seen in the last cycle, where the loan book and the deposit book were more or less moving in the same direction. But this time around, due to the introduction of the external benchmark lending rate mechanism, the volatility has been much higher than before.
Well, I was only guessing, even if the October cut doesn't come, the manner in which bond yields have fallen half a percentage point. Who did we expect from what, March, April, May? Half a percentage. So perhaps, banks have less elbow room and may have to give some kind of concessions. Okay, I'll come to revisit margins, time permitting. But clearly 2,000 rupee, you're not factoring it in at all. 2,000 rupee.
We don't see that being a very big. Okay. We don't see it as a very big impact.
Okay, now let me come to volume. That's loan growth. Loan growth, again, numbers were pretty impressive for almost all the leading banks. What here on? The assumption by economists is that last year the advantage was a lot of foreign loans were getting repriced, getting replaced with Indian loans. Sometimes even bond market loans were coming into banks. So banks were had a many-sided advantage. Now, will they be able to repeat the 16 to 18% which the leading banks did?
Looks unlikely. Again, you're going to see some disappointment coming through on those numbers if you have kept those as your numbers. We are building in a number probably closer to about 300 to 400 basis points lower than that number for the system as a whole. Now, the good part of today's loan growth is that the distribution of credit that we are seeing out there is pretty healthy. You are seeing contribution coming in from the corporate side. You're seeing pretty healthy contribution from the SME side as well as on the retail side. But having said that, to some of the concerns that you have raised, our expectation is that on the corporate side, you might see some softening of demand, partly because some of the demand which came in last year was probably aided by replacement of foreign credit or replacement from the bond market side, or probably some of it was led by some inflation-led factors, which may have probably reversed during the course of this year. We are still quite optimistic on the SME side. We're still quite optimistic on the retail side. There is no major concerns at this point of time, either in terms of price appreciation or asset price appreciation or even income appreciation at this point of time as a point of worry. So we are comfortable having a lot more optimistic outlook on loan growth, but lower than where we were as compared to what we saw in FY23 at least. Overall, take a number closer to about 12 and 14% should be a number for this year in terms of your overall loan growth.
Okay. So now Mahesh is giving us two very important things. NIMs can go down by between 10 and 15 basis points. That's his base case. And loan growth also is not 16 to 18, but more perhaps like 15 to 16. A few percentage points lower than what we have seen this year. Okay, Mahesh, that's big. But now let me come to, I don't know how much you can talk stock specific, but in this case, I don't see how I cannot ask you. The most unexpected underperformer, or maybe expected underperformer, has been HDFC Bank. Obviously, they were gathering deposits for the upcoming merger. Now it looks like they are done because the Reserve Bank has not given any leeway on SLR CRR, which means they are prepared with the deposits. So do you think here on we can see HDFC Bank being a market performer in terms of margins, ROA and price?
Yeah, so we'll break it up into various parts. I think we should see this. Most of the uncertainties around HDFC Bank is now practically completed today. The only last part which is pending out there is how they start mobilizing deposits as we go across. Q4 was pretty impressive from their side, where they kind of mobilized close to about 1.5 lakh in terms of overall deposit mobilization in a single quarter. If they can sustain these kind of numbers, or probably even a little bit lower than this as well, I think they should be home in terms of deposit mobilization, which means that practically all the concerns that we probably had on the bank ahead of the merger will be completed.
No, may I interrupt? Oh, no, that they have done a fabulous job of getting the deposits is obvious from the numbers. But that has had its impact, no? The NIM didn't move at all. So many other banks, their otherwise lower competitors, improved by 20, 30 basis points. Likewise, ROA. They were the only ones to report a lower ROA. I mean, even Bank of India reported a higher ROA. So will those burdens on the ratios end, and can we see them improve?
Well, then you got to understand that HDFC Bank's loan book is not exactly comparable with what you see with the other banks.
Yes.
If you look at their portfolio that they have, the retail book that they have is a little bit more dominant on the auto side, on the personal loan side. Whereas if you look at the banks which has seen the highest margin expansion have been banks which have also got very large housing loan portfolios. When you look at RBI's data on how the yields have moved across the various segments, you'll see that it's the housing loan portfolio which has seen the maximum improvement in the lending yields during this entire rate cycle. What HDFC Bank on the other side has given you is that the book has got a very high share of fixed rate loans. So as and when they come up for repricing, you will start seeing their margins being a lot more stable. Whereas the rest of the banking system, let's say an ICICI Bank or an Axis Bank or a State Bank of India, could potentially show a decline in net interest margins from levels that they have reported. The same will not happen in the case of HDFC Bank simply because of the construct of the loan book. So there's nothing too much to be worried about in what HDFC Bank has reported from the lack of margin improvement, at least last year.
Okay. Before I come to the big ECL question, expected credit loss question, just a word more on where are the valuation gaps now? What's the overall look of your head of research on where shares are headed? Where will banks, how much will banks be able to return in terms of share price increases? And what are your favorite pockets?
Well, it's a tough question, but let me answer it this way. There is no serious dislocation in prices available in the markets anymore. Like during the corporate NPL cycle, you probably had a lot of opportunities sitting in these large banks like the State Bank of India or an ICICI Bank. During COVID, you had a lot of opportunities coming in some of the banks which are impacted by that segment of the portfolio. Some of it is now playing through. For example, microfinance is seeing a very sharp recovery in asset price, in at least price appreciation in recent months. The way we are seeing right now is that we think we have one set of large banks like the likes of an SBI, ICICI and Axis, which we think should do reasonably well. We also think some of the mid-tier banks will also do well, mainly because yes, they're probably in the last leg of reduction in credit cost. But the challenge here is that you need a slightly more favorable macro for the second-tier banks to do well as compared to the frontline bank. So if there is any dislocation in the market coming in from an external environment, then probably the large banks do well. Otherwise, our best bets would be that the second-tier banks do well. So you have the likes of IndusInd Bank, Bandhan Bank, probably even one or two PSU banks which does well in this leg of the market.
Okay. I'm told I don't have time to discuss the ECL, and maybe I'll invite you for a separate discussion. But just tell me how much we should worry about this expected credit loss. Is it something that will start getting factored in, like in a few months?
RBI's, at least the draft guidelines said that we will probably start, even if everything is in place, probably by FY25. So banks have about a year for them to kind of strengthen their backend infrastructure to make this transition a little bit easy. RBI has also given some enough leeway saying that there will be a 5-year transition period on the tier 1 calculations for complying with ECL norms. There are some places where we are comfortable in the sense that the provisioning that the banks are carrying on their outstanding stock of bad loans looks reasonably comfortable. It is only on the early stage, which is a stage 1 provisioning, where we still aren't clear as to how are they going to look at these numbers. If you're going to look at a longer dated cycle, let's say between a 20-25 year cycle, our guess is that the provisioning numbers could be higher. But if you're going to take a smaller duration for your calculation of your ECL provisions, the number might come out to be lower, because the pain which the banks took on the corporate side in the last 15 years, most of it has now practically come down to zero. So it's a question of the time duration which RBI is probably going to look at, which will make a complete change on your ECL provisioning at least. But having said that, at this point of time, there is no serious concern. These are just adequate provisions that you're building for strengthening the balance sheet. So we don't think so it should be taken too negatively from our side, at least. That's how we are looking at the ECL provisions for now.
Okay. Well, thank you very much for that. I guess a more meaty discussion is called for on this when things become a little clearer. But thank you very much, Mahesh. The key takeaways, margins will shed off a few basis points. Loan growth will shed off a percentage or two. And if macros oblige, then it's the mid-tier banks that will do better. On that, we wrap up this edition of Bazaar. Chartbusters up next.